We can hear you.
Okay, good. I'm going to shut off my video just because there's a lot of activity going on behind me and I don't want to distract things. But I want to get started. Welcome to week 3 of our study group. This particular topic is kind of jam-packed with regulatory items for fringe benefits, retirement plans, deferred compensation, all of those things and other payments. So let's just jump right in. Of course, if you have any questions, all you have to do is stop me and I'll jump in.
And please go ahead.
Yeah,
I was just everybody type in their name.
Yes, please add in your name. For Dolby, can you list the individuals so that we make sure that we give you credit for your attendance? Okay, so our agenda for this week is non-taxable benefits, employer-provided benefits, other plans. Our retirement plan items are qualified plans, deferred compensation plans, the deferred compensation regulations, and your non-qualified plans. Our cafeteria plans, flexible spending arrangements and agreements, tax deposit requirements, and your quarterly returns. So let's jump right in. Of course, you're going to want to make sure that you remember the little test tip we'd given you before, and that was to make sure that you understand how to calculate pre and post tax items as well as the glossary so that you know what those terms, what they're asking for. Fringe benefit rules. Employers must determine if benefits they provide to their employees qualify as taxable income and are thus subject to federal income tax withholding, Social Security, Medicare, and FUTA. Employers may treat these benefits as being paid on a pay period, quarterly, semi-annually, annually, or other basis, but no less frequently than annually. The table that we've given you to tell you whether something is taxable compensation or non-taxable compensation, that is crucial that you know where your benefits fall so that you know how those items are going to be taken into consideration. For example, something that you may not come across all the time but is going to pop up on the exam is parking, your transportation benefits, such as an employer paid commuter fee in excess of $270 a month. Only that excess portion would then be taxable. Your group term life insurance, anything in excess of $50,000, the premium is taxable to the employee, less of course whatever they may have paid for that premium. Your IRS requirements on calculating this. The amount of any benefit an employer must include as income. The way you determine that, the calculation is includable fringe benefit amount is the fair market value less the employee paid amount after taxes plus the amount excluded by law. So when it comes to something like those parking items, what's the cost of that? If it's $300 and the excluded amount by law is $270, the potential amount the employee could receive as an additional income, taxable income, would be $30, but you would obviously need to take into account whatever that employee may have paid. Again, test tip, know and practice this calculation. Company pays for a parking space in a nearby commercial lot for employee, and the fair market value of the space is $380 per month. Erica pays $75 each month for the space with her after-tax dollars. The amount included in Erica's income each month is determined as follows: $380 minus the sum of 75 plus 270. Therefore, her taxable amount is $35. That is the amount of income she would be charged tax on. For non-cash benefits, employers may use one of three methods to withhold federal income, Social Security, and Medicare taxes from non-cash benefits. You can add the included fringe benefit to the employee's regular wages for a payroll period and calculate the withholding on the total amount. The fringe benefit amount may be spread over several pay periods to lessen that tax impact of adding it all at once. They may treat the included fringe benefit amount as supplemental wages and withhold federal income tax using that optional tax rate of 22%, like Melissa showed us last week. Or if the employee's year-to-date supplemental wages exceed $1 million, the employer must use the mandatory flat rate of 37%. And of course, those estimated tax payments are included on quarterly forms 941 for the period in which that fringe benefit is considered paid. The actual cash value of these benefits must be reported no later than Q4 on that 941. Non-cash benefits, your special accounting rule. Employers may treat fringe benefits provided to employees during November and December of one year as being paid during the next year. The rule applies only to those non-cash benefits provided during November and December. Employers must notify employees of their decision to use the special accounting rule. Employers can choose to use that special accounting rule for some benefits and not others, but if the rule is used for one benefit, it must be used for all employees receiving that benefit. Employers can use different ending dates during November and December for each benefit. Employers can use the special accounting rule on their can use the special accounting rule on their personal tax returns only if the employer uses it, and they must use the rule if the employers use it. So it's got to be a same situation. Your example is really helpful. Darla is provided a company vehicle which can be used for personal purposes. Using the special accounting rule, Darla's employer can value the personal use of that vehicle from November 1, 2019 through October 31, 2020, and include that value on Darla's 2020 Form W-2. We have our first pop quiz. All of the following benefits are taxable fringe benefits except which one? The correct answer is B, employer contributions to health plans. Under IRS rules, employer contributions to a health plan is not taxable. Cash payments such as gift cards, group term life insurance in excess of $50,000, and reimbursement for relocation-related moves are taxable. Non-cash benefits, Section 132. Internal Revenue Code Section 132 exempts certain fringe benefits from inclusion in income once certain conditions are met. They're not subject to federal income tax withholding, Social Security, Medicare, or FUTA. These fringe benefits include no additional cost services, qualified employee discounts, working condition fringes, de minimis fringes, qualified transportation benefits, on-premises athletic facilities, and qualified retirement advice. We'll get into each of these now in just a second. An employer may offer free services to its employees without including the fair market value of those services in the employee's income if the following conditions are met. The free service is one that is regularly offered for sale to customers in the normal course of the employer. The employer bears no substantial additional cost, including lost revenue and additional labor, in providing this service to the employee. The term employee includes current and former employees who have left because of retirement or disability, and their widowers, spouses, and dependent children. The service must be available on equal terms to each member of a group of employees whose classification does not discriminate in favor of your highly compensated employees. John is a cashier for a company which owns hotels around the United States. While on vacation, he and his wife and children stay for free at a company-operated hotel where there is space available. The free hotel room is a non-additional cost service, which means it's not considered his income, therefore he is not taxed on it, even though he also receives housekeeping services incidental to the room. So any little perks employees get, not all of them would be considered taxable. Qualified employee discounts continued. An employer may offer discounted goods or services to its employees without adding the fair market value of the discount to the employee's income if the following conditions are met. The discount on goods cannot exceed the gross profit percentage when the goods are sold to the customers. And of course, you would need to calculate that out. Total sales minus cost of goods sold divided by total sales. The discount on services cannot exceed 20% of the price at which the services are offered to customers. The goods or services must be offered for sale to customers in the employer's line of business. The discount is available on equal terms to each member of a group of employees whose classification does not discriminate in favor of your highly compensated employees. Real estate, whether for investment purposes or not, does not qualify for the employee discount. Neither does personal property held for investment such as stocks, bonds, and securities. The term employee includes current and former employees who left because of retirement or disability, their widowers, spouses, and dependent children. De minimis fringe benefits. An employer may provide certain property or services of small value to employees without including the value in their income if the following conditions are met. The value of the benefit is so small that accounting for it would be unreasonable or impracticable. The benefit should be offered on an occasional basis in order to qualify. The term employee means anyone to whom the benefit is provided. These de minimis fringes may include occasional printing of letters, personal use of the company copier, occasional parties or picnics, occasional tickets to sporting events, coffee and donuts. I mean, you can read all of those items. It's pretty standard that those de minimis items are not included in their income, but it cannot be cash. Gift coupons, gift certificates, the like must be included in income. A working condition fringe benefit. Employers may offer certain work-related property or services to employees without including the fair market value in the employee's income if these conditions are met. The employee's use of the property or services must relate to the employer's trade or business. The employee would be able to take business deduction on his or her personal tax return if the employee paid for the benefit themselves. The term employee means a current employee, partner, director, or independent contractor performing those same services for an employer. The employer must maintain the required records to substantiate the business deduction. These working conditions may include business use of a company car or airplane. Note that has to be business use. Chauffeur or bodyguard for security, professional dues and membership fees. Employees' subscription to business periodicals, job-related education, goods used for product testing for employees, use of demonstration automobile by a full-time car salesman, distinctively marked casual items of clothing issued as uniforms to police officers and firefighters, outplacement services, business use of cell phones provided primarily for business purposes. Cell phones, your working condition fringe benefit. The guidance says when an employer provides a cell phone to an employee primarily for non-compensatory business reasons, the IRS will treat the employee's business use of the cell phone as a working condition fringe, which then would not be included in their income. Examples of substantial non-compensatory business reasons include the employer needs to be able to contact the employee at all times for work-related emergencies. Employer requires the employee to be available to speak with clients at times when the employee is away from the office. And the employee needs to speak with clients located in other time zones at times outside of the employee's normal workday. A cell phone provided to promote the morale or goodwill of an employee, to attract a prospective employee, or as a means of furnishing additional compensation to an employee is not provided primarily for non-compensatory business purposes, and therefore the fair market value of the cell phone will be included in the employee's income. An employer may provide certain transportation fringe benefits to its employees without including the fair market value in their income. Transportation between work and home in a commuter highway vehicle provided by the employer if the vehicle seats at least 6 adults other than the driver, at least 80% of the vehicle's mileage can be expected for commuting, and at least 50% of the vehicle's seating capacity, excluding the driver, is used by employees. Transit passes, tokens, or fare cards, or reimbursement for them by the employer. Parking provided on or near the employer's premises or at a park and ride facility. Employers cannot provide the benefits through cash advances without the benefit being taxable. However, employers can offer cash compensation instead of qualified transportation fringe benefit, and the amount of cash offered will be included in income only if the employee chooses the cash instead of the transportation fringe benefit. This company in our example offers all of its employees a choice between an $80 transit pass and $80 a month in additional compensation. Only those employees who choose the cash instead of the transit pass must have that $80 included in their income each month. Next pop quiz. A qualified transportation fringe benefit allows employers to provide employees which of the following benefits on a tax-free basis? You all got that one right. The answer is C, transit passes for public buses not to exceed $270 per month. The IRS rules allow employers to provide the qualified transportation fringe benefits of transit passes, commuting in commuter highway vehicle, and parking. When meeting certain requirements, qualified transportation fringe benefits up to $270 per month are not taxable. An on-premises athletic facility and qualified retirement advice. An employer may allow its employees to use an on-premises gym or other athletic facility free of charge without including that fair market value of the use in the employee's income if the following conditions are met. The athletic facility is located on the employer's premises, whether leased or owned by the employer. The athletic facility is operated by the employer through its employees or other entity. Substantially all use of the athletic facility is by employees, their spouses, and their dependent children. The term employee must include those current and former employees who left because of retirement or disability, as well as their widowers. The athletic facility is not on a resort or other residential facility. Qualified retirement planning services provided to an employee and his or her spouse by an employer maintaining a qualified plan are excluded from income and wages. The exclusion does not apply with respect to highly compensated individuals unless the services are available on substantially the same terms to other employees offered such services. You'll see this a lot or hear this a lot in this particular section. It cannot, any benefit you offer cannot be given in favor to those highly compensated employees. Another non-cash benefit is moving expenses. Employers often pay their employees moving expenses or relocation expenses when they relocate to begin a new job. All amounts reimbursed must be included in income and are subject to federal income tax withholding and Social Security, Medicare, and FUTA. For a member of the armed services, if the move is due to a permanent change of station, the moving expenses incurred due to the move are not included in income and are not reported in Form W-2, Box 1, 3, or 5. The amount paid directly to the employee excluded from income is reported on Form W-2, Box 12, Code P. Amounts reimbursed by an employer or paid to a third party are wages and must be included as such in boxes 1, 3, 5 of Form W-2. Awards, prizes, and other income exclusions. Awards and prizes provided to employees by employers are generally included in their employees' income and are subject to federal income tax withholding and Social Security, Medicare, and FUTA taxes. There are exceptions for certain non-cash awards that comply with several restrictions. Your length of service awards or safety achievement awards, those tangible personal property items that are less than $400 fair market value, civic and charitable awards, prizes for retail salespeople that are, of course, non-cash. Under the clarified definition, cash and cash equivalents, gift cards, gift coupons, or gift certificates other than those conferring only to the right to select and receive personal property from a limited array of such items, like if you give an employee a magazine of things that they get to choose from, as long as those items are under $400 fair market value. Gifts provided to employees must be included in the employee's income and are subject to federal income tax withholding and Social Security, Medicare, and FUTA taxes, unless they can be excluded as a de minimis fringe benefit. We have another pop quiz. Pay close attention to the wording. An employer pays $268 per month for an employee's parking spot near the job site. Calculate the taxable amount of that monthly parking. Excellent, you guys all got it right. The answer is 0. And it was definitely a trick question. And I want to just kind of give you that heads up that the exam does have a few trick questions, at least that I found when I was doing it. So always pay attention to the wording Under the IRS Qualified Transportation Fringe Benefit Rule, the fair market value of parking near the employee's job site or at a park and ride in excess of the monthly exclusion 270 and 220 is the monthly taxable value. Since this particular example was below 270, taxable amount is 0. Continuing our employer provided benefits, we're going to talk about the personal use of company vehicles. When company owned vehicles are used for business related purposes, the value of the vehicle's use is excluded from the employee's income as a working condition fringe benefit. All other use of the vehicle is personal use and is generally considered taxable income to the employees. If employees use company-owned vehicles for both business and personal use, the employees must account for their employer's the business use of the vehicle. This is done by substantiating the miles driven, the time and place of driven, the business purpose of the travel. You have a couple of different methods for computing the valuation methods. The general valuation method or the special valuation method, which includes commuting valuation, annual lease valuation, and the vehicle cents per mile valuation. The withholding on company provided vehicles. Employers can make the choice to withhold federal income tax on the value of the employee's personal use of that company provided vehicle. And they can do that for some employees and not others. If employers elect to not withhold, they must still include the value of the employee's personal use of the car on the employee's Form W-2, Box 1, 3, and 5. The option to not withhold federal income tax from the employee's personal use of the car does not extend to the employee's portion of Social Security and Medicare. It's simply saying they get the choice if you want to withhold federal income tax or not. FICA is still required. Value of commuting. $1.50 per one-way commute and $3 per round trip if the following conditions are met. The vehicle is owned or leased by the employer and is provided to the employee. The employer requires the employee to commute to and or from work in the vehicle. The employer has a written policy prohibiting the employee from using the vehicle for personal use other than commuting or de minimis personal errands, and the policy is enforced. The employee is not a control employee. Instead of using these definitions, the employer may choose to treat all its highly compensated employees as control employees for purposes of commuting valuation method. The more common approach is the annual lease method. The fair market value of employees' personal use of the company provided car is determined by multiplying the annual lease value, or ALV, of the car by the percentage of the personal miles driven. So step 1, you would find that fair market value on the IRS annual lease value table. And then 2, calculate the percentage of personal miles driven for the year. In our example, Gilbert drives an employer-provided car that he uses for both business and personal driving. Gilbert drove 17,000 miles during the year, 12,300 business miles, and 4,700 personal miles. The car's fair market value is $24,500. The amount of the car's fair market value that must be included in Gilbert's income for the year is calculated as follows. ALV of a $24,500 car from the table is $6,600. The percent of his personal miles, 4,700 divided by 17,000. The percent is 27.65% of those total miles driven were personal. Fair market value of the personal use is that 6,600 times 27.65%, or $1,824.90. That is how much his income would be taxed or increased, and then he would receive tax on those for federal Social Security, Medicare, should he choose federal, of course. The accounting of cents per mile method. Fair market value of the personal use of a company provided vehicle is determined by multiplying the IRS standard business mileage rate by the number of personal miles driven. The business standard mileage rate is 0.56 for 2021. Employers must expect the employees to regularly use the vehicle while conducting the employer's business, or the vehicle must actually be driven at least 10,000 miles annually, including their personal use, and must be primarily used by its employees. The fair market value of the vehicle placed in service in 2020 cannot exceed $51,100 for all vehicles, including the fleet average values. If employee pays for fuel, the mileage rates are reduced by 0.055 per mile for 2021 to account for that employee paying for their own. Employee Margaret drives a qualifying car 16,000 miles during 2021, including 7,600 personal miles. If Margaret's employer pays for the gasoline of the car, the fair market value of her personal use of the car is calculated below. Fair market value of personal use, 7,600 times 0.56 is 4,256. If Margaret pays for the car's gasoline, the fair market value of the personal use of her car would then be reduced by that 0.055 per mile, or 7,600 times 0.505. You will want to remember how to practice, or you'll want to practice this and remember this particular calculation. I know I even had in the test the fact of what the maximum value that vehicles cannot exceed, that 51,100. Our next pop quiz. An employee drove a company vehicle 5,000 miles for business and 6,000 miles for personal. The car is valued at $53,650. Which of the following statements regarding the employee's use of this vehicle is true? Great job. The answer is C. Out of the safe harbor methods, the employer must use the annual lease value to report the value of the employee's personal use of the vehicle. Group term life insurance. A couple of things to take note on. FUTA withholding is not required, but Social Security and Medicare tax withholding is. This is reported on Form W-2, Box 1, 3, and 5, and 12 with the code C, Forms 940 and Form 941. The value of coverage in excess of $50,000 minus any amount the employee paid for the coverage after taxes must be included in the employee's income. So you would calculate it as follows. Step 1, determine the total amount of the employee's group term life coverage under the employer's plan. Calculate the excess benefit over $50,000. Divide the excess insurance amount by 1,000. Find the employee's age as of December 31st, during which the benefit is taxable. Use the IRS table 1, uniform premiums to calculate the fair market value of 1 month of excess insurance per 1,000 and multiply it by the answers obtained in step 3. Deduct any after-tax contributions made by the employee. Add the excess amount to the employee's income, withhold and pay Social Security and Medicare tax, and report the amount as required. Little test tip. You will need to know how to calculate this, but they do give you the IRS table so that you don't have to remember what amounts per 1,000 you would calculate by. In our example, Valerie was born on April 23rd, 1962. Her employer's non-discriminatory group life insurance plan provides her with coverage equal to 2 times her annual salary as of January 1. Her annual salary as of 1/1/21 was $65,000. Her employer's plan has a maximum coverage amount of $125,000. Valerie contributes $25 per month in after-tax dollars towards the insurance premium. So step 1, 2 times 65,000 is 130,000. But we already know that the maximum coverage amount is 125,000. So her 2 times annual salary won't apply. We're going to go with that maximum amount of 125,000. We need to determine how much of that 125 is in excess of 50. That would be 75,000. 75,000 divided by 1,000 is 75. Valerie will be 59 years old on 12/31/21. The rate is 0.43 times 0.75 times 75, is $32.25. However, she paid $25 per month of that coverage. Her taxable income on this group term life insurance would be $7.25 per month for 2021. If Valerie did not pay anything for the group term life insurance or had paid with only pre-tax dollars, the entire $32.25 would be included in her income each month. Whole life insurance is handled just a little bit differently. A whole life policy provides 2 types of benefits: a death benefit, where the benefit is payable only at the death of the employee, or a savings plan. A portion of each premium payment is applied towards the savings segment of the policy. As premiums are paid, this cash surrender value of the policy increases. If the employer is the sole beneficiary of the policy, or employees pay their premiums with after-tax dollars, the value of said policy would not be included as income to the employee. If the proceeds of a policy are payable to the employee's beneficiary, the amount included in the employee's income is taxable and is the sum of the increase of the policy's cash surrender value for the year, the reasonable net premium cost, the death benefit payable minus the cash surrender value at the end of the year. The reasonable net premium cost per 1,000 of current insurance for 1 year is determined by referring to the IRS interim table of 1-year term premiums. This one is probably less widely used. Personal use of a company aircraft. General valuation rule: the value of a personal flight on an employer-provided aircraft, where the employer also provides the services of a pilot, is determined by the amount an individual would pay to charter a comparable aircraft and a pilot for comparable flight. The non-commercial flight valuation rule: the value of a personal flight where the employer provides the aircraft and the services of a pilot is calculated by using an aircraft multiple based on the weight of the aircraft in a cents per mile rate, known as the standard industry fare level. So you would use the standard industry fare level times mileage times aircraft multiple plus the terminal charge. Flights for relatives of airline employees is calculated at 25% of the airline's highest unrestricted coach fare in effect for that particular flight. This means 25% of the fare must be included in the employee's income and is subject to federal income tax withholding, Social Security, Medicare, and FUTA taxes. Educational assistance for employees paid. The employer pays for or reimburses the cost for educational courses. If they're job related, it's excluded from income when not required for the position or for a promotion or transfer. Non-job related, the IRC Code 127 provides an income exclusion of $5,250 per year for non-job related educational courses and must be provided through Educational Assistance Program or an EAP. Any payments in a year that exceeds $5,250 for non-job related education are subject to federal income tax withholding, Social Security, Medicare, and FUTA taxes. Individuals eligible for tuition reduction assistance include employees, retired or disabled employees, and their widowers, spouses, and dependent children are not included in employee income. Your scholarships and fellowships, qualified scholarships and fellowship grants, including tuition payments and related expenses, are excluded from an individual's income if the individual is a candidate for a degree in an educational institution. Scholarship programs can also provide grants to employees, spouses, and children without resulting in income to the employee. Business travel expenses. Employer reimbursements of employee business travel expenses can be excluded from income only if the expenses are incurred while the employee is temporarily, less than 1 year, away from home from their primary residence overnight on the employer's business. In our first example, Joan is regularly employed in New York City. In 2021, Joan accepted work with her employer in Buffalo, which is 400 miles from New York City. Joan realistically expected the work in Buffalo to be completed in 6 months and planned to return to New York City at that time. In fact, the employment lasted 10 months, after which time Joan returned to New York City. Because Joan realistically expected that work in Buffalo would only last 6 months, it did in fact last less than 1 year, and Joan had always intended to return to New York City at the end of her employment in Buffalo. This employment is considered temporary. Thus, any reimbursements for Joan's travel expenses by her employer are excluded from income if they are paid under an accountable plan. Our next example, the facts are the exact same setup as example 1, except that Joan realistically expected the work in Buffalo to be completed in 18 months, but in fact, it was completed in 10 months. Joan's employment in Buffalo is indefinite because she realistically expected that the work would last longer than 1 year. Even though it actually lasted less than 1 year, the reimbursements for Joan's travel expenses paid by her employer are included in income regardless of the employer's reimbursement plan. Third scenario, the facts are same as example 1, except that Joan realistically expected the work in Buffalo to be completed in 9 months. After 8 months, Joan was asked to remain for 7 more months, for a total actual stay of 15 months. Therefore, Joan's employment in Buffalo is temporary for 8 months and indefinite for the remaining 7 months. Reimbursements for Joan's travel expenses incurred during the first 8 months are excluded from her income if the employer reimburses her under an accountable plan, but the remainder of the reimbursements must be included in her income. Reimbursements under an accountable plan. To be an accountable plan, an expense reimbursement or advance payment program must meet the following conditions. There must be a business connection in connection with the performance of or services of the employer. Substantiation, amount, time, place, and business purpose. Returning excess amounts, fixed date method, and period statement method. So that would mean the employee returns any amounts they have not yet used. Overnight local lodging if certain criteria are met. In our first example, the employer conducts 4-day training session for its employees at a hotel near the employer's main office. The training is directly connected with the employer's trade or business. Some employees attended the training are traveling away from home, and some are not. The employer is requiring all employees attending the training to remain at the hotel overnight for the bona fide purpose of facilitating the training. The employer pays the cost of the lodging at the hotel directly to the hotel and does not treat the value as compensation to the employee. The training is a bona fide condition or requirement of employment, and employer has a non-compensatory business purpose for paying the lodging expense. The employer is not paying the expense primary to provide a social or personal benefit to the employees, and the lodging employer provides is not lavish or extravagant. The employees who are not traveling away from home had paid their own. If the employees who were not traveling away from home had paid their own lodging, the expenses would have been deductible to them as ordinary and necessary business expense, meaning on their personal income tax returns. Therefore, the value of the lodging is excluded from the employee's income as a working condition fringe. Reimbursements under a non-accountable plan. If an employer's reimbursement plan fails to meet any one of the requirements under an accountable plan, it is a non-accountable plan, and payments are subject to federal income tax withholding, Social Security, Medicare, and FUTA. We'll just go over one example. Company reimburses its employees for business travel expenses while away from home under a plan requiring employees to substantiate their expenses with receipts within 14 days of returning home. Company also gives its employees $50 a month as an allowance to spend on office supplies without requiring substantiation or return of amounts provided in excess of actual expense. The monthly office expense allowance program is a non-accountable plan that the IRS would treat separately from the travel expense reimbursement plan. All payments made under the office supplies plan are included in the employee's income when paid. Your per diem allowances. Rather than requiring employees to substantiate the actual expenses they incur, employers may provide reimbursement in the form of a per diem allowance for each day of travel. Paid for ordinary and necessary business expenses incurred or reasonably expected to be incurred by an employee for meals, lodging, and incidentals while they're traveling away from home. They're reasonably calculated not to exceed the amount of the expenses or expected expenses, and they're paid at the applicable federal per diem rate or other IRS approved rate, or is paid under a flat rate or stated schedule in accordance with normal business practices. Your types of allowances would be meals provided, special transportation, things like that. An employee's transportation expenses incurred going between his or her residence and a work location generally are non-deductible personal commuting expenses rather than a deductible business expense. An employer's reimbursement of the transportation expenses are taxable wages unless the expenses are deductible and the employer reimburses them pursuant to an accountable plan. Special circumstances, of course, breaks in service and recurring but infrequent trips. Another pop quiz. Employer paid meals or lodging is taxable when? Correct answer is D, staying in the company's guest quarters for 3 months after transferring while a new house is under construction. That is the item when it would be taxable. Your mileage allowances. You can use the flat rate or stated schedule, paid on a regular and objective basis and paid at a stated schedule. The fixed and variable rate allowance uses flat rate or stated schedule that combines periodic and fixed variable rate payments. Keep in mind that travel expenses of a spouse, dependent, or other person, not including business associate, accompanying an individual on a business trip, are not deductible as a business deduction unless specific criteria are met. Taxation and reporting requirements. Here's the really good table to try to keep in your mind under accountable plan or non-accountable plan, which is reported on your Form W-2 and which is not. So when the slides come out, this is a really good one to keep track of. Your meals and lodging. Employer provided meals may be excluded from an employee's income. Employer provided meals are not subject to federal income tax withholding, Social Security, Medicare, or FUTA if the meals are furnished on the employer's business premises. They're furnished for the convenience of the employer. Employer provided lodging. The value of employer provided lodging is excluded from the employee's income if the lodging meets the following requirements. The lodging is furnished on the employer's premises. The lodging is furnished for the employer's convenience, and employees are required to accept the lodging as a condition of employment. Your advances and back pay awards must be included in an employee's income for the payroll period when received and are subject to federal income tax, FICA, and FUTA at that time. The federal income tax, if amount repaid is the same year received, it is not taxable for federal income tax. Federal unemployment tax, if the employee is under the wage base 7,000, then a refund on FUTA can be claimed on Form 940. And FICA, Form 941X, must be filed if the employee repayment is after the quarter that the employee received the amount. When an employee wins a lawsuit or settlement against their employer for alleged violations of federal and state employment laws, the amounts awarded are often considered back pay for wages unlawfully denied. They are subject to federal income tax, FICA, and FUTA. In most instances, taxable back pay awards should be treated as wages in the year paid rather than the year earned for income withholding and employment purposes. It's reported on Forms 941 and on Box 1, 3, and 5 in their W-2. All back pay, whether or not awarded under a statute, is wages except amounts specifically designated otherwise, such as damages, interest, penalties, and legal fees. Another pop quiz. Repayments of wages from a prior year, which of the following is true? And it kind of gives you the answer there. So we'll go ahead and just circle that. What happens with repayments of wages from a prior year? It requires the completion of a Form W-2C and 941X. Bonuses and commissions. Assigning bonus paid to the employee for signing a contract is taxable for federal income tax, FICA, or FUTA, and is reported as wages on a personal income tax return. A contract cancellation payment is taxable for federal income tax, FICA, or FUTA, and is reported as wages on a personal income tax return. Push money exception. When a manufacturer pays a bonus to salespeople working for the retailer to get them to push their products, the bonus is not wages because it's being paid by a third party, It is not taxable for federal income tax, FICA, or FUTA, but is reported as wages on a personal income tax return. Under commissions, full-time insurance salespeople are governed by special rules. Commissions paid to them are not subject to federal income tax, but they are subject to FICA and are excluded by FUTA only if the salesperson is solely paid by commission. They have to be a commission-only person. Death benefits paid upon an employee's death to his or her estate and beneficiaries must be reported on Form 1099-R if they're paid under a qualified plan. Death benefits from a non-qualified deferred compensation plan must be reported on Form 1099-MISC to the estate or beneficiary. The benefits are not subject to Social Security or Medicare taxes. Your disaster relief payments. These would be really important when you think back to like Hurricane Katrina, when a lot of 401k payments could be paid out and they did not have to be claimed as taxes. They could be, tax-free. They did not receive penalties and all of those things. The IRS code states that gross income does not include any amount received by an individual as a qualified disaster payment. Jury duty, the tax treatment of wages from an employer for time an employee spends on jury duty, depends on the employer's policy in providing the wages. If the employer pays the employee's wages in addition to jury pay received from the government involved, the wages are subject to federal income tax, FICA, and FUTA. If the employer pays the employee the difference between what they would receive for their regular pay and the jury duty pay, only that difference is subject to the taxes. If the employer pays an employee their wages for time spent on jury duty and requires the employee to turn over their jury duty pay, only the difference between the amount paid and the amount turned over is subject to federal income tax, FICA, and FUTA. The employee may deduct the amount turned over on his or her employee personal income tax return. If a juror is paid at least $600 by a state or political subdivision, that amount is not considered wages, but must be reported on Form 1099, Box 3 as other income. Our leave sharing plans. Employees donate a certain number of paid leave days they have available and unused, which are then deposited in a leave bank. Employees who participate in the plan and have medical emergencies can then use those paid days from the bank. Those wages are subject to federal income tax, FICA, and FUTA. Payments that are retroactive are treated as wages when they are made and subject to federal income tax, FICA, and FUTA taxes at the current rates and under the current wage limits. So similar to those back pay items. Your taxable tips, I think we'll stop here and pick this piece up tomorrow because tips can be a little bit in depth if people have questions on what is considered taxable and what isn't. So we made it in our first day. Does everyone just love this topic?
Thank you, Rebecca.
Yeah, thanks.
You're welcome. You're welcome. Okay, on that note, we'll see you tomorrow.
See you tomorrow.
Okay,
Okay, bye. Thanks again.